Welcome to Investing Insights. I'm your host, Ivana Hampton. What's old is new again. Investors are shifting away from AI leaders, like those that make up the Magnificent Seven, and falling back in love with laggards, like value and small cap stocks. So, how long can this market rotation persist? Morningstar Indexes strategist and the Longview co-host, Dan Lefkovitz, has researched the recent market drama. Let's check out our conversation. It's great to see you again, Dan.
Great to be with you, Ivana.
Well, we're talking about the market rotation that started in Q3 is continuing into Q4. You have been tracking the trends. Tell us what you've seen.
Yeah. So first, to sort of set the scene, if you think about the last 10, closer to 15 years for equity investors, the action has really been in the U.S. market in that large cap growth, large cap core sort of space, over value stocks, over small cap stocks, over international stocks from the perspective of a U.S. investor. And now starting in the third quarter, we really saw a change, as you say, a rotation in market leadership. So just looking at the performance of Morningstar Indexes, value beat growth. We saw small cap beat large, and we saw our global ex-US index beat our Morningstar US market index. We also saw equal weight US equity index beat the market cap weighted version, which is really interesting.
And key moments in the third quarter ignited that market volatility. For example, NVIDIA's earnings beat estimates, but the stock still dropped. Dan, can you talk about why investor sentiment has been fluctuating like that?
Yeah, I think key moments is a good way to put it. All sorts of triggers, from earnings announcements like NVIDIA's to inflation prints and job reports. Berkshire Hathaway trimmed its stake in Apple, which kind of spooked the market. I thought it was ironic that both an unexpected interest rate hike in Japan and an expected interest rate cut in the US contributed to volatility in the third quarter. Granted, it was a larger cut than many people expected. But I think, the fact that if you think about these moments, some of them were fundamental, some of them were technical, some of them were macro, some of them were micro, some of them were domestic, and some of them were foreign. And that kind of speaks to what moves markets in the short term and makes markets so hard to predict. But, taking a step back, I think we saw a real shift in the narrative. If you think about, the market over the past 18 plus months, ever since the launch of ChatGPT in late 2022, it's been all about artificial intelligence and its transformative promise, and AI has been the theme that has really powered markets. In 2023, it was all about the Mag 7. In 2024, we saw more of the same. And I think in the third quarter, we really saw kind of a shift from that enthusiasm to jitters, to fears, to concerns over the economy, over the narrowness of the market and the priciness of the market from a valuation perspective.
So that was a lot of moments where people had sort of been predicting this is coming, and it started to show its face.
Yeah.
Well, NVIDIA and other Magnificent Seven stocks led that almost 2-year rally. But value stocks are beating growth right now, like you just said. Is this the start of value's comeback? Why or why not?
Yeah, I mean, NVIDIA is a really interesting story. It's a phenomenal company, obviously sort of the poster child of the AI-led market. It's a wide moat company in the eyes of Morningstar equity analysts. I encourage people to read our take on NVIDIA. I guess the question there is, how much is already reflected in its share price? How much of its, amazing, gravity-defying growth trajectory is already priced in? And fears over the sustainability of its growth, I think, is why the stock price fell, even when the company beat earnings estimates. And that's the thing, that's the risk with growth stocks, is they carry the burden of high expectations. Whereas value stocks, the idea there is that they can underpromise and overdeliver. So yes, we saw value stocks outperform starting in the third quarter. We saw small caps outperform starting in the third quarter. These are areas that haven't participated as much. So I think as maybe investors look to the health of the economy, surprising health of the economy, to interest rate cuts by the Federal Reserve. Stereotypically, value and small caps are more sensitive to the economy. They have more cyclical exposure. They're more sensitive to interest rates. So I think the idea that these areas could benefit and the broadening of the market could benefit value stocks and growth stocks. Now, you had a question about whether it's sustainable.
Yeah.
That is is anyone's guess. I guess one note of caution I would sound is we have seen value rallies before that have kind of fizzled out. Most recently in 2022, maybe you wouldn't call it a rally, but value held up much better than growth in a huge equity market downturn. We saw a big dispersion between the growth side of the market and the value side in 2022. And then, of course, along came ChatGPT and growth took off again. And, some would say it kind of reflated the growth tech stock bubble. So in 2016 was another time when value and small caps outperformed, but it ended up being sort of a head fake. So one quarter doesn't make necessarily a lasting rotation make.
Something to watch.
Yeah.
And what does Morningstar think about the outlook of value in small cap stocks?
Yeah, so our colleagues on the equity research side put out their fourth quarter outlook. I encourage folks to read it. And I want to get this quote right. They said, "The great rotation out of overvalued and overextended large cap growth has more room to run." So they certainly see further upside in value. They see further upside in small caps. Our colleagues on the investment management side at Morningstar also like small caps and think that there's more room to run there. They also like equities outside of the U.S. in certain markets.
And income investors are probably liking what's going on with dividend stocks.
Yeah.
What's fueling their outperformance against the broader market?
Yeah, this was really interesting. So we definitely saw a lot of Morningstar dividend indexes perform well amidst this rotation. So if you think about dividend investing, dividend payers, they tend to have a value bias, especially traditional equity income sort of portfolios, more so than dividend growth, which is more of a core kind of quality strategy. So as sectors like financials and healthcare and utilities, which benefit from rates coming down stereotypically, that has helped the dividend paying section of the market. We also saw our Morningstar US Dividend Growth Index outperform during this rotation, thanks to some of those sector biases.
Let's not forget about bonds.
Yeah.
How have they performed from Q3 to early Q4?
Yeah, bonds, very, very important, really a positive story there from the perspective of diversification, income investing. So bonds have done really well and have held up well during equity market sell-offs and during volatility that we saw starting in the third quarter. Our Morningstar US Core Bond Index was up during really volatile periods of the beginning of August and the beginning of September, which is important because in 2022, stocks and bonds both sold off together, right? So there was a simultaneous sell-off in equity and fixed income, which a lot of people called the death of diversification, the end of the 60-40 portfolio, referring to that classic mix of 60% equities and 40% bonds. Now we've seen bonds once again act like a diversifier and cushion losses in equities, like they did in 2020 and during the financial crisis, 2008 or the early 2000s. So the fact that bonds are kind of zigging while equities are zagging is good news from a diversification perspective. The fact that yields, even with the interest rate cuts, bond yields are still high, in the context of the past 15 years or so, that gives them a higher starting point than they've had from a total return perspective.
Inflation is moderating. Recent job data looks strong, and the Federal Reserve is signaling more interest rate cuts. Q4 looks promising, Dan. Has your research shown anything lurking beneath the surface?
Yeah, well, I guess first I'd sound a note of caution about the consensus. The consensus can be wrong. That certainly is kind of the outlook that most people are expecting. But how wrong were we about, the economy? How long was that debate raging of soft landing versus hard landing? We still haven't landed yet. At one point, the market was expecting 7 interest rate cuts in 2024, and here we are in the fourth quarter, and we've only gotten 1. So the consensus could be wrong, and there are no shortage of risks lurking beneath the surface. There are always, known unknowns out there, unknown unknowns that could upend markets. Valuations, I think, are still high from a historic perspective. I'm stating the obvious here, but geopolitical risk is elevated. We have an election coming up. There are all sorts of macro and micro risks. There's policy and regulation. There was a great article on Morningstar.com recently about regulation that could threaten the tech sector, and we've seen antitrust action against Google. So being prepared for all sorts of risks that could threaten the equity market. One of the lessons I think from Q3 was that volatility just comes with the territory of stock market investing. Even with all of the bumps in the road that we saw, the U.S. market index was still up 6% over the third quarter. It's still up, roughly 20% year to date, which is well above the historic annual average, and we're only in the third quarter.
What would you tell investors if they're wondering if this market rotation will persist?
Yeah, I guess I'd say that market leadership is changeable, and markets are dynamic. If you think about the period from 2000 through 2009, it was a lost decade for U.S. Stocks. The market was down over that 10-year period overall, but value outperformed growth, and small caps outperformed large. Bonds outperformed stocks. International outperformed U.S. So I think it makes sense to be ready for, I'm not necessarily predicting that that's going to, happen again, but you have to be prepared for a range of outcomes. And I think, diversification and having exposure to all different kinds of assets that could perform should market leadership change and should the rotation persist makes a lot of sense. I think a lot of portfolios these days are very heavy on U.S. large cap growth and large cap core stocks, given their phenomenal run. But like I said, we have seen periods where that segment underperforms. So you want to be ready should that reoccur.
Well, Dan, thank you for coming to the table and sharing what trends we should watch for in Q4.
Thank you so much, Havana.
Here's the markets in brief for the week ahead. Earnings season is picking up speed. Verizon is scheduled to report its third quarter results on Tuesday, October 22nd. Tesla is set to unveil its quarterly performance on Wednesday, October 23rd, and so is Boeing on that day. And bad news keeps rolling off the jet maker's assembly line. It's navigating through years of turbulence that's recently intensified. How can it reset and rebound? Nic Owens is an equity analyst for Morningstar Research Services and covers Boeing. We talked about how the plane maker is trying to pull that off. Thanks for coming back on the podcast, Nic.
Thanks for having me, Ivana.
Boeing CEO Kelly Ortberg has recently announced 17,000 job cuts worldwide. He said the layoffs would affect all levels. How did the company get to this moment?
Well, as you probably know, starting 2018, 2019, they started having trouble with the 737, a whole series of events, grounding the fleet, COVID, which disrupted their whole manufacturing process, has led them to, and they also behind the scenes were betting on defense contracts that they lost the money on. So their defense business has had $10 billion of write-offs, and they've lost $35 billion since 2018 on making airplanes. So the bottom line is they have to cut costs to stay competitive, and that's really where they're at. I think there's some multiple factors that led to where they're at.
And a follow-up question, Boeing has announced it's raising money to shore up the finances as it faces a risk of a credit downgrade. Can you give us the details?
Sure, yeah. And they borrowed a bunch of money in COVID, like a lot of companies, but haven't been making money to pay it back. So they issued a filing to issue a combination of equity and debt up to, I think, $25 billion over 3 years. It looks to me like they have about $15 billion of short-term debt over those 3 years that they'll probably refinance. And this filing means that they are talking to the banks. The banks are willing to lend them at reasonable rates, and they'll probably issue about $10 billion of equity sometime soon. And that will probably allow them to keep the investment-grade credit rating, which is a good thing for their costs. And they'll use that money mostly, I think, for working capital and pay off a little bit more debt.
And the new CEO has told everyone, the company needs to stop spreading itself thin and focus on the core. Can you talk about what Boeing is delaying and possibly eliminating to move forward?
Yeah, I don't have a lot of detail on that. There's some candidates, right? So they've already been reported to be marketing their share in the United Launch Alliance, which is a joint venture with Lockheed Martin. They won't make a bunch of money on that, but it will be removing a distraction. I think there's a version where they might reorganize their services business, which has been a steady money maker, but does some stuff that is sort of un-Boeing related. They might fold most of that back into the commercial business. And then, depending on how deep they cut, they might, and depending on what NASA decides, they might shelve the Starliner that had the, left two astronauts in space for a couple months. Again, an unprofitable program, over budget, overdue, maybe not something that they would today say is their bread and butter.
And at the time of this recording that we're doing right here, the Machinists strike is at a stalemate. How far apart are both sides in the contract talks, and what are the sticking points?
Yeah, so I think they might not be that far apart on money in terms of, but they're on a stalemate on this issue of the union is asking to reinstate the defined benefit pension plan, sort of an old-timey pension plan, and the company is basically saying, no way. And on the one hand, that kind of is a sort of classical negotiating strategy where you ask for something that's hard to give and then you get other things instead. But it takes time in this context for those counter positions and counter proposals to kind of take shape. The original number in terms of the cumulative raises that the union members were expecting over 4 years was 40% raises, and the first offer that they voted down was something closer to 33%. So couple more percentage raises and maybe finding a way to make something better about the existing retirement plan is, I think, where they'll end up. They have to come up with some face-saving proposal.
So it's something to watch.
Yeah.
Well, Boeing is scheduled to release its third quarter earnings on October 23rd. They have delivered a lot of bad news lately. What are you looking for from management when you hear that call?
Well, it'll be the first time the new CEO is on one of these calls from my perspective, and that'll be interesting in and of itself, just kind of hear their style and so forth. The bread and butter really is the 737, and so I want to hear more about what they're doing to get that back in shape and being able to consistently produce them, progress on their purchase of Spirit Aero to consolidate the supply chain. That's really kind of the number one thing. There's other big programs like 777 and others that I will want to hear about. And if they have more detail on like what they might be shutting down or giving up, that'll be interesting.
And how should investors approach Boeing stock right now?
Well, so I think there's long-term value here. Our fair value is over $200. But with the high uncertainty, because of all the stuff we're talking about, we wouldn't rate it 5 stars until it traded below $120, $121. And it's, getting closer to that. And there may yet be other bad headlines, like if the strike extends another month and that sort of thing. But when they can get the 737, 787 assembly lines back to, let's call it normal, so consistently pushing the planes through without having to rework, which has been costing them a ton of money, there's a lot of pent-up demand for the planes. They've already sold the planes, but delivering them means a really positive cash flow boost, and getting those assembly lines profitable again will make a huge difference to the company. And I'm pretty sure they will get there. It's just a matter of how long it'll take.
That's probably on top of the new CEO's to-do list.
Yes.
Well, Nic, thank you for coming to the table and sharing your insights into Boeing.
Thanks again for having me.
That wraps up this week's episode. Thanks for watching and making this show part of your day. Subscribe to Morningstar's YouTube channel to see new videos about investment ideas, market trends, and analyst insights. Thanks to senior video producer Jake Vankerson and associate multimedia editor Jessica Bebel. I'm Ivana Hampton, lead multimedia editor at Morningstar. Take care.